Bear Bull Traders. Andrew here with Ardi. And we want to have this new session talk about overall market and sometimes some trading opportunities. We're going to practice with that. So if you like it, make sure to subscribe or and comments and see what you think about this.
Sorry.
No, don't cut it. We'll keep doing it. Why are you laughing at it?
I love the opening. It's really good.
But okay, so don't cut this, Santiago. Let's just keep it in there. But no, seriously, we want to talk about the market in 2023. Obviously,
best investment opportunities for 2023.
So 2023 is going to be a recession. Yes or no? I mean,
that's what they're saying.
They want a recession. First of all, why do they need a recession?
To bring inflation down.
So price stability.
Yeah, price stability.
So by raising the interest rates.
Absolutely.
So what does the Fed, which is essentially Federal Open Market Committee, their mandate is to be very clear and open with the public what they're going to do and what's their future and forecast. Yeah. What do they want to do in 2023? Price stability with lowering the employment and.
So Fed he's been actually what we talked about is open market committee. It's open market. Everybody are supposed to know their next move, right? They've been very clear. They don't want to make the mistake of the 70s. 70s they brought the rates down too soon, and then inflation picked back up. And Powell has said it in his speech. He want to kill inflation once and for all. So how do you kill inflation? With recession, but they can't really come and say, hey, we want a recession, we want you to lose your job. They're being more political. They started talking about soft landing, but if you actually read the Fed's minute, there is no soft landing. I mean, we looked at it the other day, right? I showed you some of the stuff.
So you probably can put a screenshot in there, Ardi, if you want to bring it up or not. So they have this interest rate and employment projection.
Yeah.
And Ardi, you're actually showing that in your screen. You want to talk about it?
Yeah, absolutely. So this is called economic projection. They do it every quarter. Last one was in December, and they're basically saying, hey, okay, right now we're at 3.5. End of 2020. No, this is unemployment rate. Yeah. Right now we're at 3.5. By the end of 2023, this is their projection, right? The low end, the high end. They want somewhere at around 4.7 to 4.9, right? So that's 1% increase in unemployment. We know from historical fact, every time unemployment ticked by more than 1%, it triggers a recession, no question about it. So they're telling you they want a recession.
And this is going to be in 2023 or early 2024?
Well, this is their estimate for 2023, but these are so hard to predict. Like we looked at labor market, it's still 3.5%. Quit rate is still at 4 million per month, so people are quitting their job. Job market is still really tight, right? So tighter than a bid-ask spread of Apple.
So Ardi, we discussed that. I mean, some of the tech companies are laying people, off and let people go. But do they have any meaningful, really impact on unemployment? I know Silicon Valley is under some pressure. Yeah. But the real construction, the real employment is coming from the main street, the construction workers.
Housing is the biggest one. I think it's 20% of U.S. and about 25 to 30% of Canada. So housing is the big one. The construction, the orders, the manufacturing, everything, the material. Yeah.
So if they slow down the buildings and constructions, then that slowly trickles down to other sectors and unemployment comes up. And it's very interesting that their projection is that unemployment in 2023 should go up 1%. Yeah. So to get that price stability.
Yeah. And another thing is, Andrew, we talked about it. You said how come they can't do soft landing, right? Like how come inflation will go down and they would just stop and bring the rates down? They're not going to do it because take a look at this unemployment rate. Right now is at 3.5 here in this one. Their long-term projection is at around 4.2, 4.3. So they're basically telling you, hey, this level is not sustainable. We can't have this many people working. Right, when you look at their long-term average.
And why? Because when employment is in maximum, the wage growth is going to. Employers have to pay more and more to hire people, and that transfers into inflation.
Yeah, so I mean, they have a formula, right? They call it compensation equal inflation plus productivity. And what they're knowing is, okay, compensation is going up. They can look at productivity. It's a measure. They can look at it. It's not really changing. So they're saying basically it has to be inflation. This has to be the reason that compensation is going up. So yeah, that's why basically it's just this formula without getting too technical.
So Ardi, what I understand right now in 2023, so because of this, they say don't
Don't
fight the
Fed,
Fed.
yeah.
So obviously, when the Feds are saying cool down the economy, you got to cool down the economy. You can do that. So the stock market and essentially the companies are under pressure, so they can't really expand as much and higher. So their earning and revenue probably not going to go higher.
It's going to come down.
It's going to come down. Maybe we don't get a systematic drop, but maybe 2023, especially the first 6 months, is going to be volatile but choppy. So kind of staying between 350 to 400. What is
great? Which is great, by the way, for traders, right? It's terrible for investors.
Yeah,
but really good for traders.
Yeah, that's exactly. I mean, even 2022 was a really good trading day. I mean, a nightmare for investors, both in the bond market and in the equity markets, investors, but in the day traders and active traders, there's so many opportunities in there. So so a lot of people are watching in our community, they have big accounts and they have trading accounts. Like I myself have a couple of accounts that I'm not day trading on them. What is a good investment in them? Should we just buy stocks or there's a better investment?
So yeah, I think if you got a little bit of a long-term vision, like long-term investing account or maybe even a swing account, I think bonds are going to outperform stocks. Bonds. I mean, take a look at TLT. I mean, TLT is an ETF, right? I have it in my screen. Year to date, it moved from 101 to 107.
That's 8% move.
That's almost 8% move, right? So
I think a SPY is only 2-3%.
2%, exactly. 2.5% for a SPY versus 8% on TLT. So bonds are gonna outperform. We know during recessionary time, by the way, bonds are the ones that do better, right? Why? Because they have this coupon that pay you, so you're getting cash flow. That's.
We did mention that in this week newsletter that how do we find bonds? The TLT is the mixture of all the treasuries.
Yes. So the TLT is from 20 to 30. It's a mixture. It's an ETF.
ETF,
right?
yeah. Is there any good corporate bond that we can buy? Like market historically was giving us like S&P 500 8.5%. That's
8.5%.
over the
That's
10 years.
yeah.
Historical. So you showed me in TWS, Interactive Brokers platform, that there are some high quality bonds that give you 7-8%, like not junk, but that have risk, like 7-8%, like Bank of Nova Scotia, which is a very strong Canadian bank, like 8%, 7%.
Yeah, I mean, JP Morgan, I saw a callable bond preferred about 9%. So there's a lot of opportunities in the bond market. If you're trading bond or you know about bond, I mean, there's risk involved. We don't want to get you trading
What's
bonds.
the risk? The default of the bond?
Well, there's credit risk, which is the default, but you also have duration risk. So how long is that bond? Is it expiring in 10 years, 15 years? And then how sensitive is it with the interest rate movement? So
can you show us, for example, that how do we get those bonds?
Yeah, so I'm in my TWS right now. This is by Interactive Broker. Just come to the new window and go to scanners, and they have a bond scanner. And this is really, really powerful. So let me just press OK here. So you can kind of take a look. Do you want to go after corporate bonds, U.S. certified deposits, U.S. treasuries? If you want to buy 1 year, you can go to U.S. Treasury and click if you want a T-bill. T-bill is 1 year.
Yeah, Treasury bill, yeah.
T-note is between 1 to 10, and T-bond are more than 10. So you can actually go ahead and take a look at some of these stuff.
Show us, because we can dive into that for a long. Show us a good corporate bond that is giving us 7-8%. How can I find?
Yeah, I mean, Wells Fargo right here. I just went to corporate bonds. Wells Fargo right here is giving you 6.4% yield. So you buy it at 91. You buy obviously at the ask, right? You buy at 97. I mean, you gotta.
So the spread is so big.
The spread is really big. So that's another thing. These are OTC, right? All the corporate bonds are OTC. You're trading with investment banks directly. So you got to be really smart picking your bid. But let's say 92, 93, and then you get back 100 at the time of maturity. But you can also trade these, right? You can sell them a month later, 2 months later, 6 months later.
So if I, for example, have $2 million, instead of putting it on S&P 500
and chop
getting chopped next year, I can just put my money in there and collect 6.7% in there. We can say almost risk-free. I mean, because this is JP Morgan and the credit risk is not there.
Yeah.
And the interest rate, the projection of interest rate is going to either stay or come down.
Which is good for bonds.
Which is good for bonds.
Yeah.
So if the interest rates are not going to go up like in 2020, then you don't have that much of a risk on the interest rate. That seems like a very, very solid investment in 2023.
Yeah.
until the market starts picking up again.
Exactly, and that's what the smart money is doing, right? We saw that headline from Bloomberg. So far, in the last 22 trading days, maybe less than 22 days. What is it? Last like 18 trading days.
Yeah.
$600 billion has
Moved
been
into
raised.
the bond market.
In the bond
Well,
market.
that does make sense because you wanna stay in a risky asset.
Yeah.
Like to get 8% when you can have risk-free 6.5%.
Not quite risky.
I mean, not
but
quite
yeah.
risky, but really, really solid
Yeah.
probability of going well there.
Yeah.
So that's one of the reasons that the market doesn't have any reason to go up. A lot of people are asking what happens into the market. Most likely it's going to stay choppy or maybe a little bit lower. But if I have a hedge fund and I have millions of dollars under management, I probably stay away from these risky assets for now until the Feds really become a little bit dovish, and then put my money in the bonds.
Yeah, which is what we've been doing for the Peak Capital Wealth Fund,
Yeah.
right? Like we've been switching to the bonds since December, right? Changing our allocation there over there. Another good thing, Andrew, sorry to interrupt you, is this is really, really powerful tool. This global bond scanner by Interactive Broker gives you the ability to search, your rating. So if you're a risk taker and you want yield, you can go ahead and search kind of junk bonds. Maybe this is kind of the triple B of S&P rating, and then let's go ahead and maybe a fallen angel somewhere around here, and you can kind of see how interesting the yields get. I mean, I saw Bed Bath & Beyond yielding 70-80%, Coinbase, one of those guys. So you got 14.5%, 10%, 11%. And these are
these still investment grade or they're junk?
Depends. So let's actually take a look at Navi, for example, and see what's the rating on Navi. 5.5% semi-annual. This is in financials. Let's see if you can see ratings here.
I mean, that's interesting. But anyways, if you want to go with the higher yields one, you got to probably be careful of risk management and diversification.
You got to know what you got to do. Yeah,
that's definitely something that But it's interesting. I mean, generally, switching from equity to bond market, at least for the first 6 months of 2023, doesn't seem like a very bad idea.
No, absolutely not.
And they're you can trade them. Can sell them anytime. You're not locked in.
Yeah, you can sell them. They're tradable, and if you have a idea about where the interest rate is going, you can actually trade them based on that. If you think interest rate is going to go up, bonds are going to go down, you can sell them. Very similar to
what
stocks.
does the market, that's another interesting, guys, that the Federal Reserve has an interest rate and have a projection of interest rate, but in the yield curve, the market tells you what the Fed they think is gonna do in the future. You mentioned that in a 1 year, the interest rate is actually a bit lower. It means that the market thinks that the Fed is going to pivot this year?
Yeah, so I think the 1 year now is 4.6, and the Fed is telling you they're going to 5 to 5.5, and they're staying there. So the market is already cutting 50 basis points for the Fed. It's basically telling the Fed, hey, you're going to cut. You're not raising. That's what the market is saying. Yeah, it's very interesting, right?
That's very interesting. So the market thinks that the Federal Reserve is going to make enough slowdown in the economy that they have to even bring down the rates to push the growth.
And think about it this way: the 1 year, the rates, it's a discount coupon. So that 4.6% is basically by billions of transactions. So this is like
it's not one or two institutions.
This is like really smart money coming to this price, right? Due to a lot of transaction that is happening. So
that's interesting.
It's really interesting, yeah.
All right, so this is how many minutes so far? We're almost done. Okay, so thank you so much, guys, for watching us. And we're gonna do this a couple of times a week because Ardi and I have a lot of interesting conversations together, and I think some of it could be good for you. Obviously, we need your support and comments and feedback and suggestions. And anything, Ardi, for this session part?
I think it was good.
What should we call this part?
This conversation, like late afternoon. We wanna keep it casual, right? We don't want to be super strict.
100%.
So, after hours.
Oh, after hours. Anyways, the stock market today or some
Yeah.
discussions. But definitely, guys, thanks. If you haven't subscribed to our channel, we appreciate subscribing, and definitely give us a thumbs up if you like it. And if you have any questions, just leave it in the comments. Ardi and I are, constantly, even on our phone, checking the comments and try to engage with the community. Small community, but we really try to engage with people. Thank you so much for watching.
Yeah, likewise. Thanks, guys.
Cheers, guys.